Hi, in this session I will talk about a few different things. Number one, in precision-based trading, how do you optimize your ROI and still maintain a risk factor under a tolerance limit? Uh, in traditional investments, of course, we don't think that way. It's completely different, where emotions get involved and all those stuff. But in precision-based trading with artificial intelligence, it's not that way. You just have to think once, set up your parameters for once, and let the intelligence do its work. So there are two major components. One of it is the tolerance percentage, which you are seeing here. What does that mean? That means if you are looking into this account as I showed earlier, as on yesterday, the unrealized profit was 25668. So if we take that number 25668 divided by the investment, which was say 2 million. I'm just making it simple. So let me put the formulas correctly. Where is that I'm looking for? Just a second. Give me a minute. Okay. So now, assuming that yesterday this particular account had an unrealized of 25,000 over his original investment of say it was I think 1.98 million to be very exact. So what is the percentage? So if you take a look at the percentage, it is this divided by 1.9 original investment, which is again, if you put it in the percentage sense, it's 1.30. So what does it mean? It means yesterday, the day the trading closed, his net realization value was down from the original investment by 1.30%. So that's exactly what you are putting here, that how much you are willing to tolerate. Say for example, you say that okay, this guy was aggressive, remember, so he had a tolerance level of 10%. So that means he's allowing his investment or net worth to go down by 10%. So that means times 9, I'm sorry, equals to 0.9 times this. So that means he's allowing his net worth to come down to 1.7 a million, which is here. Why why we are worried about this part? Because remember, as per our technique, the realized profit is to be taken out. So that means this theoretically you'll be playing around between 100% or less. So if you're allowing 10% risk factor tolerance here, that means you are allowing your net worth to go down up to 1.7 million. In other words, the algorithm or the artificial intelligence, as soon as it sees that your net worth is 1.7 million, it's going to put the brakes right there. It's not going to invest for you anymore. So that's point number one. So what is important to understand is how are you controlling your risk on the overall portfolio, which is the unrealized profit. It could have 100 stocks in it on a float. Some could be at 5%, some could be at 0.0%, 0.01% on the negative side on the float, which is going to get settled the next day or the following day, as you have seen that the average stock settles within 2 to 3 days from last 20 years of data. So that's point number one. Point number two is the average of the tolerance level you're giving on stop loss. So usually based on our research, the optimum value is 5% to 10% on the long side, and on the short side it is in between 3 to 7%. If you keep it at this level for long and short, you will notice that because of the volatility in the market, you keep it to this level, you will probably get the best returns on investment. The reason is there are some questions asked in this case, that is it necessary that I will have to keep the shorting overnight? Yes, if you're using a leverage over 50%, if you're going over 50%, you'll be liquidated very likely. But if you're having a portfolio margin loan, then you're fine. But if you're just using a margin loan, but in our case, we don't use margin loan. But you could be looking into a scenario where you don't want this uh, stop loss for shorting, shorts to stay overnight. So there is also another configuration where you can say that no, I would be closing at the end of the day. So there are a lot of options for you, but this is not a recommended practice, because what happens is if the market is bull till the end of the day and there is a bad news, the next day the market starts usually lower than the previous day. So you will lose out on opportunities, and since you have booked your losses, it's already done. You have nothing else to do. But if you keep your leverages low, say 50% or 60% range, and use the buying power, which you have seen yesterday, buying power utilization, you use 80, say 75% of that you use as buying power for the cash utilization, you'll be fine. Or if you use, even if you use say 60% of your buying power which the broker gives you, you'll be okay, you'll be doing good. But then again, you have another control here where you are saying that, okay, if I'm given 60% of the buying power, do I want to use it at one time? In our case, in the performance which you have seen, yes, we used it at one shot. So as soon as the level goes higher than that, all the new investment stops. But when again the stock starts gets settling, it calculates based on the threshold how many stocks it can assign to you for the next pooling minute. Remember, there is a pooling minute which we were talking about, which could be 60 seconds or 120 seconds, on those lines. Means what? Your money is constantly in circulation within 60 seconds or 120 seconds, whatever you set as a parameter. So here there are a few things. One is either you want to use it up at one shot, and then whatever is milking out every 60 seconds, you are taking that opportunity to see what is your next possible investment from that breakout list. Or you could also say that, okay, I want to go based on an increment of 10%. Means you don't want to use your 60% in one day. You want to use it at increment of 10% in 6 days going forward. Or you could be more conservative. This is not recommended, but people who are really conservative, you could say that I can do that 10% increment provided the market is favorable, means market is bull. Usually markets are not bull for 6 days at a stretch. So you will be, maybe you'll land up with 30% and you'll be sticking there for a long time. So this is not a recommended practice, but it is doable. If you are a very conservative investor, you can take this also as an approach. So as I say, that when you put in that percentage of cash utilizations, you get all the numbers ready for you as to how much cash you can utilize. And then you have the index tolerance. Index tolerance means that, okay, if things go wrong beyond a certain percentage threshold, then I will not do anything. Okay, I will probably have a tolerance to to take that or not to take that. Say for example, when tsunami comes, like in a day, the market went down. In this case, with this type of a scenario of configurations, there'll be nothing happening. There'll be no new investments, no shorting, no nothing. Everything will be on a standstill. So the point which I'm trying to make here is very precision based. It's purely mathematical decisions which happens here within fraction of seconds. So unless you change the configuration, things will be always consistent. The third important thing is your threshold. So what does that mean? It means that irrespective of the sector, irrespective of the stock, there's no emotion, whether it is Google or Bank of America or anybody else. You are just investing, say, 50,000 in that first case, which I explained before, or in the third case, it was 5,000. So there is nothing as emotion. There's no thought process behind it. It's all mathematics. You allow repeated investments or don't allow repeated investment is also another option, where you basically can tell that, okay, tell this algorithm or the intelligence that, okay, if I am holding a stock on a portfolio, I don't want to look into it, because you might get it into the breakout. Breakout is looking into all the stocks which it is qualifying, but it doesn't know individual investors account and its configurations, but which is completely different. So when it is looking into the list, it is looking into many different things, including sort is one of the key factor. But as it sees, if it sees that it has a cash availability of, say you have set it up to, your threshold is 50,000 and your cash availability because of a settlement which happened the last minute, your cash availability is, say, 60,000. So in this case, it will give you only one stock to invest in the next 122nd or 60-second, whatever that pool is. So that means you are allowed to invest only one stock. What does that mean? That means your 60,000 is not sitting idle. Within the next minute, it's getting invested. But question is, where is it getting invested? It's looking into this factor, whether if you say I don't want to repeat it, it is going to look into the new list of stocks which is there in that breakouts which you have seen earlier is available for you to invest. But it is going to invest 50,000 only. So if you have 100 and say 130,000, it will only let you invest only on two stocks because your threshold per investment is 50,000. If it is 90,000, unfortunately, it will still let you only invest one stock because you are 10,000 short to invest from two stocks. So having said that, this is the way you keep circulating your money. In traditional techniques, we don't do that. But what is very important for you to understand is this factor, that if I am setting up my tolerance level to say 10%, under what circumstance my entire portfolio I'll lose 10%. That is only going to happen assuming that you have got 20 stocks in your portfolio and all those 20 goes down, which is very unlikely as you have seen. At that point only, you'll be losing your 20% from your entire portfolio. So mathematically and hypothetically, it's a very impossible scenario that everything goes down. Of course, there will be stocks which is on the float doing well and all sorts of stuff happening as you have seen. But I'm giving the worst scenario from a mathematical perspective. So if your stop loss is 20% and your tolerance level is also at 20%, then when every stock goes down by 20%, you are going to hit your tolerance level by 20%. But if a tsunami comes, assuming a tsunami comes, your tolerance level is at 10%. Your stop loss is at say 5%. I'm just giving an example, or even at 10%. Under no circumstance you will be losing more than 10%. In traditional technique, people lost more than 40% even within an hour. So everything is precision based and it's controlled accordingly. So it is very important for people to understand in traditional technique, the way of thinking is completely different from artificial intelligence with precision, because this is, here we are talking about quantitative mathematics here. Everything is precision. So under worst circumstance, that's why when you set up your account, you just have to make sure that, okay, what is your tolerance level you're going to give, and what is the stop loss level you're going to allow, what would be your cash utilization in terms of how conservative or how aggressive you want to be, and that's it. The algorithm will take it from here and maintain this for you. So it is important for traditional investors to understand that this is a completely a different, or it's a shifting process for your mindset. You have to change your mindset to think differently in terms of mathematical precisions. Once you understand the mathematical precisions, what is happening, you don't have to worry, it's all driven by the machine. Here, what stocks get picked up, you don't have to worry because again, it's precision. Everything which is coming into that list of breakouts is going through a very large data set with sophisticated algorithm running behind it to tell you about the breakouts. That's why you have noticed that 75% or sometimes even 80% of our breakouts leads to a success story. So keeping that in mind, 4:1 as a success to failure, and your presets here, which I have just explained, is what's going to drive your returns on investment. So if you have any further questions, feel free to ask me, call me, my number is there, and I'll be more than happy to explain it to you.